Hi, in this video, we will talk about the price to earnings ratio or the PE ratio as it is commonly known as. PE is a fascinating concept and almost everybody in the stock market looks at it, tries to kind of invest basis this, take decisions basis this. तो PE को क्या drive करता है वो हम जानेंगे इस particular video में. Stay with me till the end. We will look at all the aspects of what drives PE across sectors and how do we interpret whether PE is too high or too low. My name is Piyush. Welcome to another video on our channel. If you haven't subscribed to it as yet, please do it right away. Let's jump right into the concept of PE. When we look at price to earnings as a ratio, what we are basically looking at is how much price are we willing to pay for one share of the company that makes us or gives us an entitlement to the earnings per share of that one share, right? So price divided by EPS or earnings per share of the company. So let's take, for example, there's a company whose stock price is 200 and let's say their earnings per share is 10. If I buy this share, it gives me an entitlement of rupees 10 worth of earnings in this particular company. It's an entitlement. It's not necessary that the company is going to pay me that 10 rupees right away at this point of time. But over a period of time, I would be entitled to that as a shareholding in the company. I'm paying 200 rupees for this particular entitlement, effectively paying 20 rupees for 1 rupee of earning. This 20 is basically what is called as the PE ratio. Now imagine there is another company which is exactly the same. Similar size, similar business, similar kind of risk profile, and this company's stock price is trading at 300 rupees while its earnings per share is 10. So in this particular case, you're paying 30 rupees for 1 rupee of earnings in the company. In the first case, we were paying 20. In this case, we were paying 30. All other things being equal, we would prefer the lower one because why would you want to pay more for the same rupee of earnings? But the caveat here, once again, I'll repeat, is all other things being equal. In real life, all other things are rarely equal. I mean, if you think about companies where you think are very similar companies, the first couple of examples that will come to your mind would be things like Infosys and TCS. And even there, TCS is significantly larger than Infosys. So they can't exactly be compared completely, right? So it's important to kind of understand what drives this multiple. Before we go into that, let's look at one more element here. If I actually take this equation of share price upon earnings per share and multiply the numerator with number of shares and also multiply the denominator with number of shares, what happens here, right? So the numerator, when we say share price into number of shares, will basically become the market capitalization of the company. The denominator, which is earnings per share into number of shares, remember, will become the net profit for the company because that's how you calculate earnings per share, right? Your EPS is nothing but net profit of the company divided by number of shares, right? So that is what we get with respect to this idea. The moment we do that, the equation becomes market cap upon net profit of the company. Same equation, you'll get the same PE metric for the company, but I intuitively find this better because rather than saying 200 rupees per share price divided by 10 rupees EPS, here you get a sense of size and scale of the company as well. So you'll get to know 2 lakh crore is the market cap and 10,000 crore is the earnings of the company. So now you have a sense in your mind, okay, how large is the business? And am I actually looking at that in any of my decision making when I'm using the PE as a metric, right? So that's another element that can come in. There are more caveats to it. If I take the numerator as the price and take the denominator as historical earnings, the last 12 months of earnings, that is something called as a trailing PE. Right, last 4 quarters of earnings, if I take the EPS of that and divide it there, divide using that set of EPS, that is what will give me the trailing PE ratio. But if I look at the numerator as the current price and the denominator as my expectation of next year earnings, that is called as a forward PE ratio. Right, now try a quick exercise here. I will list down the names of 6 companies. Right, I want you to try and find out what is going to be the PE ratio of these. You can go to one of these websites like Screener and try and note down these companies' names, and once you put the company's name on the website, you'll get the PE ratio right on the initial part of the company page screen that you see. So look at 6 companies. Look at HUL, look at Infosys, look at DMart, Nykaa, ONGC and Titan. 6 companies: HUL, Infosys, DMart, Nykaa, ONGC, Titan. Go to the Screener website, try and find this out. I have these with me. As of the time of recording this, these are the current PEs of these particular companies. So you'll see HUL at 54, you will see Infosys at 23 approximately, you will see Avenue Supermarts or DMart at 97, you will see Titan at 84, you will see FSN e-commerce, which is Nykaa, at 734, and you will see ONGC at about 8.5, let's round it off to 9, right? Now obviously these are different sectors, different size, different scale, different risk factors of the company, so I can't directly compare them across. But there is still a very wide range of numbers that we are getting. There's one number that is 9 and there's another number that is 97. Even if for a minute I assume that something like a Nykaa may be an outlier here and I ignore that, which is at 700 kind of a number, we are looking at a range between 9 and 97, right? So what is really driving this? And the bigger question in your mind should be that, okay, 9 is fine, 97 is fine, but if you want to buy one of these stocks, if you are evaluating any of these stocks, then when do you buy them? I mean, do you just kind of blindly follow the idea that if PE is low, then ONGC should be a good buy? Or, if PE is high, then DMart should be a good stock to sell at this point of time? Or there is more to this nuance? Clearly there is more, right? Because there are different sectors, there are different companies, these are different businesses, and their PE ratios have been kind of around these numbers for a while. So let's dig a little bit deeper into that. Let's look at what is common in all of these, right? If you look at the ones which have a slightly higher PE, you will look at the likes of HUL, you will look at the likes of FSN e-commerce, Avenue Supermarts, and Titan. Do you think there is anything common in these? What is the commonality in these companies? If you think a bit, you will know that these are all consumer companies. B2C companies is where you typically see a slightly higher PE ratio. That's what business to consumer companies do or get in India. They get a premium because there is a very large customer or consumer profile, and because there is a very large customer or consumer profile, you have a runway of doing sales and business for a very, very long period of time. That probably is one of the factors, right? The other two companies where you see this is low, these are B2B in nature, right? Now, that doesn't mean all B2C companies will have a high PE or get a higher multiple or a premium, or all B2B companies will get a low multiple. That's not necessarily true. But in the user set or the set that we have just kind of taken together, here we find that the B2C ones have a slightly higher multiple, the B2B ones have a slightly lower multiple. So let's try and dig a little bit deeper into it, right? Now imagine for a minute that we look at a company whose stock price is 200 and EPS is 10. We go back to our initial company and just be with me for a bit. Assume that this particular company is not growing, zero growth. There is no growth in this particular business. EPS this year is 10. If there is zero growth, EPS next year should also be 10. And then the next year after that should be 10 and so on and so forth. If you paid 200 for this company, how many years will it take to recover your money? 20, right? But 20 was also the PE. Intuitively and mathematically, can I say that PE is the number of years in which you will receive or recover your money that you've paid for a company, assuming the company stops growing or degrowing? Assuming exactly 0% growth, how many years you will get back your money? And that's what effectively or mathematically your PE will work out to. So 200 rupees, 10 rupees EPS, I'll get 10, 10, 10 across multiple years. 20 years, I will get my money back, correct? That's a PE ratio. Now, in this light, think about HUL, where the PE ratio is something like 54, and think about ONGC, where the PE ratio is something like 9. In other words, you are okay giving your money to HUL management for 54 years if they stop growing, but you're not okay giving the money to ONGC for more than 9 years. 9 is where you kind of draw the limit. Now, I'm not going into whether these numbers are correct, incorrect. We're not doing that as an exercise. We're just trying to kind of figure out what explains this very large, wide range that we are seeing, right? So now dig a little bit deeper. What makes HUL trustworthy to be given your money for 54 years, right? Or more than 50 years as against, let's say, an ONGC. Think about the businesses. HUL is a fast-moving consumer goods company, FMCG company. They manufacture soaps, they manufacture toothpaste, food products, sell those. Do you think these products will get sold 20, 30, 40 years down the line? The answer probably is yes for all of us. The runway that such a business has is much longer because there is predictability and stability in the business. ONGC, on the other hand, is not something that you are sure about, that it will definitely have that stability, because A, it's an oil producer. We don't know 20 years down the line what kind of world we will be in. I mean, surely and definitively we are moving towards a world where more electric vehicles, more cleaner energy will come in. So we're not completely sure of what the future is. Plus, the predictability also gets affected by the fact that it's a PSU entity. So the government does what they want to do, right? One fine year, the government will come out and say that, okay, let's go and buy another company like HPCL. About a decade or so back, when petrol and diesel prices were regulated in India, ONGC was asked to share some of their profits towards that fixing of petrol prices and so on and so forth. There have been other instances as well where the meddling of the government does not leave a lot of predictability. So the first factor that is very, very clear and is impacting the PE ratio is something around stability. If a business has more stability, if its earnings have more predictability, you are more likely to give a higher multiple to that particular business. That explains part of the story here, right? Now, let's imagine there is another company. And now in this company, let's reintroduce the growth component as well. So let's say the company has the EPS of 10 in the first year, 12 in the second year, 15 in the third year, 20 in the fourth year, and so on and so forth. Now, of course, there is a little bit more math to it. The company is growing, so they must be reinvesting something. They will not be distributing everything. So you're not going to get 10, 12, 15, 20 in that context. But maybe the company returns a part of it and you kind of keeps, you get what is continuously growing over a period, right? If that is the case, maybe you're willing to pay more for this business because it's growing faster and it's returning your money most likely faster, right? Maybe you pay 300 for it, which tells you that the second parameter that drives PE ratios is growth. If you have stability in the earnings, companies will get a higher multiple, markets will trust them a little bit more and hence give them a higher multiple. If you have high growth, markets will give companies a higher multiple. And because this scenario plays out, stability and growth, when both of them come together, the multiples tend to appear very aggressive, right? So you look at a Titan, you look at a DMart, that's possibly because earnings are also growing at a reasonable pace and there is predictability in the business, and hence you get that kind of a multiple. Look at Infosys on the other hand. While it's a stable business, you could argue that, equal stability to HUL, or at least at par. If it is an equally stable business, low risk, no debt, lots of cash flows, it still gets a lower multiple because it's in a segment which is prone to disruption. Trends change very quickly in this business. Unlike FMCG, which is a very predictable, you can be sure that 20, 30, 40 years down the line that business will exist. IT services not necessarily will exist in the same form or fashion. Does that mean it can't get bigger and better? No, it can. But the market may not trust it with the same amount of stability. Of course, with something like Infosys, there are other ancillary factors at play at this point of time around tariffs and what's going on in the global economic scenario at this point of time. So we won't go there. But intuitively, there are two parameters that we see are driving PE ratios, stability and growth. Stability, A, is a function of the kind of business you are in. B is a function of the competitive advantage or strength that a business carries, right? The more stronger you are, the more competitive advantage you have, the lesser the unpredictability in the business. Nobody will be able to come and dent it so easily. And growth is a function of opportunity size. If you believe opportunity size could be large, right, then maybe the PE ratio looks large today, but if the company keeps growing continuously, then that's possibly fine. I mean, look at companies. If you look at the example of a company like Dixon Technologies, or if you look at the example of a company like Eicher Motors, in their growth period, they grew many-fold. Dixon had revenues of something like 3,000 crore in 2018. They ended the last year with a revenue of about 40,000 crore. Eicher Motors had a volume of 50,000 bikes that they used to sell in 2010. That volume went up to something like 70,000 bikes a month, from 50,000 a year to 70,000 a month in 2018, right? So when you see such kind of a growth, the markets tend to kind of give a multiple to all such companies. It's not necessary that when the market is giving a higher multiple to any particular business that this will always materialize, but we can rationalize a little bit of it, saying that as long as you can believe in stability and predictability of the business, it is unlikely that you will get these businesses at lower multiples, right? Significantly lower multiples. So the core question for us is, if HUL is at 54 and I want to buy HUL as an investor, or I'm an analyst who's evaluating HUL as a business, do I wait for the PE to come down to 10, 15, 20, or do I take a call somewhere in that range it has been? If I'm looking at Avenue Supermarts, do I take a call at, do I wait for it to kind of come back to 20, 25, 30, or do I kind of assume that, it's always going to kind of carry a premium? Globally also, the large retailers, the Walmarts and the Costcos of the world, trade at a reasonable PE multiple. It's not like they trade at single digit PEs, right? So there is a fair possibility that DMart might appear expensive at 97 or 100, but if I keep waiting for it to come back down to 20 or 30, I may not get that opportunity at all. So if you are an investor, or if you are a fund manager, or you're a buy-side analyst, then remember, you have to kind of align your understanding of where the PE ratio is. By no means am I saying that these are correct multiples. That's not the idea here. I'm not saying that we should go and buy these stocks today or not buy these stocks today. The objective, however, is that you don't just go and blindly follow that 10 is a great PE ratio and 50 is a very high multiple that you're giving to a company. In a market like India, an emerging market like India, where earnings are growing, remember, the question you need to ask is, whatever the PE a company is getting, why is it getting that? उसे वो PE क्यों मिल रहा है, right? कुछ history है क्या कि अगर 10 का PE मिल रहा है तो क्यों मिल रहा है? मार्केट में इतना information है, everybody knows about the company. Why hasn't it changed if it was such a value pick in such cases, right? The second question you need to ask is, what will cause a change in this multiple? If it is 10, what will make it 20? If it is 50, what will take it to 30? And unless you are very sure about what will cause that change, it's a fair possibility that it exists or moves around in that band for a fairly long period of time. Just keep that in mind. That broadly is what we wanted to kind of discuss on the PE metric and PE ratio. There's of course a lot more to discuss on PE, which may be beyond the scope of this particular video. But this is a good starting point. Try and look at various companies, try and understand how kind of PE ratios work across sectors, and try and kind of align whether it is stability or growth or a combination of the two that is driving. One final point, FSN e-commerce or Nykaa may not be a good example to look at from the multiple of or lens of PE multiple, purely because it's growing fast, it's in early stages, and in such cases the earnings may not be completely reflective of the true earnings potential of a company. So for early stage companies, we typically do not rely directly on PE ratios. We will probably be looking at multiples like price to sales or so on and so forth. That's for another day. That's it in this particular video. If you liked it, please share your thoughts and feedback in the comment section. What else you want us to cover, please share that in the comment section as well. That's it from me. Thank you.